Right now, are you concerned about the stability of our banking and our financial system, or are you concerned about runaway inflation? Now, most people would simply answer both, but these things are actually at odds with each other. The reason is because today we have a global financial system that is built on top of a giant foundation of hundreds of trillions of dollar IOUs. This is a chain of dollar IOUs where you have $1 that's been lent out over and over and over again from one financial institution to the next. And if one link in this chain breaks, the entire system fails. And in this situation, that would mean the dollar could actually strengthen extremely quickly and significantly versus other assets, other currencies, and against goods and services. And this could happen so quickly that it could put banks out of business before regulators are able to step in with a rescue plan. Now, given the size and scope of all of the dollar IOUs out there, the debt and derivatives, a rescue plan that is needed to bail this system out should one link in this chain break could literally be hundreds of trillions of dollars large. So putting this all together, we see a very possible scenario in which the following occurs. Number one financial institution defaults on their dollar obligations. This means everybody they owe dollars to can't get the dollars that they need, which means they need to sell something in order to get the dollars they need. This puts downward pressure on the things they're selling, upward pressure on the dollar. As the dollar starts to spike, everybody is forced to go and scramble for dollars as their losses get larger and larger. A global scramble for dollars takes place and the dollar becomes unobtainable overnight. And then a swift campaign by the Federal Reserve to print enough dollars to hand out to central banks to paper over these losses is what crushes the dollar for good. So how is something like this even possible? Well, let's start with the US bank situation. Silicon Valley Bank was an example of dollar liabilities. Just as all banks, they took dollars in, they turned around, and they loaned them out. So no bank actually has your dollars available on deposit. They've already loaned them out the moment you drop them off. Silicon Valley Bank, just like other banks, do most of their loans to the US government, meaning they buy treasuries. These are considered risk-free as long as you can hold them to maturity. But if everybody suddenly wants their dollars back, then you'll have to sell those loans. And right now, all those loans are at a loss. This is why Warren Buffett right now is saying we are not through with bank failures. He does not think that depositors are going to be losing money because the government will bail out depositors. But shareholders are not being bailed out, which is why he just revealed he's sold a lot of his bank stocks. These losses were not at gains. In fact, Warren Buffett has lost billions on bank stocks. Looking at Berkshire Hathaway's largest losses, we see Bank of America, Globe Life, US Bank Corp, Markel, Ally Financial, and Bank of New York Lemon. One of the best value investors of all time is saying that you do not want to be a shareholder of US banks right now. And on top of this, credit from banks is drying up. They're not able to extend the same amount of credit as they were before, as they have to pull the reins in and get tighter. This means less money to go around, and as less money goes around, that means banks have even less money to loan out. And on top of all of that, the commercial real estate crisis is starting to hit banks extremely hard right now. Commercial real estate is all made up of adjustable rate loans with balloon payments that are all maturing this year, next year, and the next. And regional and small banks are taking the hit on this because commercial real estate operators cannot afford to roll over right now since interest rates have gone up. And since commercial real estate makes up a massive portion of the balance sheets for most of these banks, this means the banks are in trouble. As these loans have a high degree of possibility of default, it's putting more stress on the banks. Now, if you're concerned about whether your bank is actually at risk right now, reach out to my friends at McAlvany Precious Metals. McAlvany is one of the oldest precious metals companies in the US. They were founded in 1972 by Don McAlvany, and now the company is run by his son, Dave McAlvany, who I consider to be a close friend. The way that they do business is different than most. They prioritize ethics, integrity, and relationships. Their precious metal advisors have an average tenure of over 20 years in the industry. McAlvany was actually the first company that was able to put precious metals inside of of retirement accounts all the way back in 1986. They become an industry leader in ratio trading between the gold and silver ratio, so that when gold is more expensive relative to silver or vice versa, they're helping you trade back and forth between the two. Now, McAlvany should sound familiar to you because they own and operate Vaulted, who I've talked about and recommended many times on this channel. And right now they have a special offer for my viewers to receive an exclusive report on the security of your bank. So if you're concerned about the safety of your bank right now, go to McAlvany.com/heresy and get a free consultation from a McAlvany advisor. So we know there's risk with US banks, but that's not where all of the risk is concentrated. In fact, the US issues are just a small fraction of the actual problem because the Fed has insight into US banks. And if a US bank fails, they can bail out the depositors without causing a glut of dollars because they have oversight, they have the data, and they're in charge of it so they can make sure they get the dollars only where they want them to be. There's well over $65 trillion in hidden dollar debt around the world. Now, part of this comes down to the euro-dollar system, which, as I've said before, is a terrible name. It has nothing to do with Europe or euros. They're not real dollars, and a much better name would be global dollar IOUs or foreign dollar IOUs. Essentially, since the creation of the Bretton Woods system, the dollar has been the global reserve currency since 1945. And that means since 1945, the United States has been exporting dollars around the world as we buy more stuff from other countries than they buy from us. Now, the Federal Reserve is the only one who can actually create new dollars, but other banks around the world will still loan dollars into existence. If you deposit $10 in a bank, that bank will turn around and maybe loan out 9 of them. And then those $9 go to another bank, 8 of those get lent out to somebody else, and so on and so forth. And those dollars can be recycled over and over and over again, creating new money because every single deposit, people think, yes, that money's actually there and I can go get that money at any time and spend it somewhere else. But it's just been loaned into existence. That happens here, it happens everywhere. The difference is in America, when that starts to unwind, like it did with Silicon Valley Bank, the Federal Reserve can print what they need and target where they need those new dollars to go to paper over any of those dollar losses. Essentially, instead of allowing the dollar supply to collapse from a bank failure, they allow it to stay the exact same. But there is no regulatory agency that oversees all banks across the entire world. And so the amount that they loan out is different, the regulations on what kinds of loans they have is different, and that's why we've seen much stress globally recently. This is what caused a problem with the Credit Suisse collapse and clients losing a lot of money. And so there is no aggregated information about how many of these dollar loans have been created all across the world. And so if there's a problem, the Federal Reserve doesn't know exactly how much it needs to print and where it needs to send them. But it's even bigger than just this Eurodollar system. The Bank of International Settlements recently came out with a report talking about the FX swap markets, because a lot of this dollar debt is actually held off balance sheet. And so it's not even like you can go to the banks and look at their balance sheets to see where the problem lies. Double or sometimes quadruple of this dollar denominated debt is held off balance sheet. Not only that, but the churn of these deals has approached $5 trillion per day. This means that every single day, there's $5 trillion worth of currency changes swapping hands that are leveraged. These are derivatives. This is dollar debt, and $5 trillion per day is a lot, which means that if there's one financial institution that suddenly can't make good on its promise to deliver dollars, then you've got a lot of fast moving parts where everybody else along that chain now, you can't give me dollars, which means I can't give them dollars, which means they can't get who they owe dollars to, and so on and so forth. Silicon Valley Bank collapsed in 48 hours. This global problem is much bigger and could collapse even quicker. And it's not just banks. There is a good portion of this considered the shadow banking system. All dollar denominated debt has approached at least 65 trillion. And when you compare that to a global GDP of 104 trillion, you can see how quickly this could turn into a problem. Essentially, you could spark a mad scramble for dollars where institutions owe today trillions of dollars. And if they don't have a way to get that, they have to sell everything else that they can in order to try and buy dollars. This means the price of all other things, especially assets and especially currencies, drop off of a cliff and the price of the dollar skyrockets. This is severe, swift, sudden, and significant deflation. Now, just in case you haven't been paying attention over the past 30 years, deflation is the Federal Reserve's biggest fear. Everything the Federal Reserve has said and done since the Great Depression has been in order to avoid deflation at all costs. This is why they've been so slow and gradual with fighting inflation recently, selling assets off their balance sheet very slowly, raising rates very slowly. It is their biggest fear to accidentally tip things over into deflation. So if something sparks a global scramble for dollars, what do you think the Federal Reserve's response will be? They will print as many hundreds of trillions of dollars as necessary to cover those losses. Stop the deflation at all costs. Stop those dollar defaults anywhere they occur. Because if one link in the chain breaks, the rest of the chain starts to fall, so immediately print as many dollars as necessary to make sure the rest of the chain stops breaking. Let's go back to the US situation one more time. With the Silicon Valley Bank collapse, all you had to do was save the depositors. Print the precise number of dollars necessary and inject them exactly where necessary to stop the bleeding. This doesn't create more money, it stops the existing money from evaporating. But this is only possible because the Fed has visibility and control of the US banking system. Two things that they do not have around the world. What they do have is the ability to get dollars to other central banks. And that's about it, which means the Fed's only option, if this starts to happen, is to print however many trillions of dollars central banks are asking for and send them over to central banks and hope those central banks get them to where they need to be and have that whole process result in not too few dollars and not too many dollars, which is technically possible, but here's the even bigger problem. Let's say that they do print exactly what is necessary to stop this default chain from rolling through the entire globe within the span of 24 or 48 hours. Essentially, you just printed at least $65 trillion. This is so that every single link in the chain who needs dollars to give back to who they owe dollars to can get dollars without spiking the price of the dollar. But this is all debt, which means once you do that, the debt no longer exists. You replace that debt with cash. Essentially, this is what quantitative easing was in the United States, where the Federal Reserve printed money and they bought debt so that banks could get rid of the debt that was at a loss on their balance sheet and get cash instead. But in this case, they're doing that for the entire world. Reading between the lines, this means a dollar squeeze leading into a global domino effect of defaults could trigger a massive global debt jubilee for all financial institutions, taking that $65 to $100 trillion worth of dollar debt all around the world and instantly replacing it with just cash. Suddenly, that means there's literally free money everywhere. The world just got to liquidate its entire debt portfolio at full price, and financial institutions around the world would be flush with cash and have $0 liabilities. Now, the initial spending power that would come as a result of that would be literally unprecedented, driving prices now sky high and the dollar down as you have the biggest dollar glut the world has ever seen. Financial markets around the world right now are walking on a tightrope. You tip over to one side, you get a deflationary death spiral. You tip over to the other side, you get a hyperinflationary collapse of the currency. Given the US banking crisis and the massive amount of dollar debt all around the world right now, and rising interest rates, means that we are currently leaning more towards the deflationary side. And given the fact that it's the Fed's biggest fear, their biggest nightmare to see deflation unfold, the chances that they overcorrect to stop that deflation are large that they will tip us over into a hyperinflationary collapse. That a dollar squeeze could overnight turn into the biggest dollar glut, ending the US dollar as a global reserve currency. Now, we are certainly not there yet, and we are not seeing any signs that this is inevitable, that this is absolutely going to happen. But the chance that this could happen is very large, considering we know the response of policymakers and the situation the world is in right now, which could be one of the biggest reasons why central banks are buying more gold right now than they've bought for the last 70 years, because they see the issues around the world, they see the sovereign debt crises, they see the balancing act between deflation and inflation, and they want an asset on their balance sheet that doesn't depend on somebody else fulfilling their end of the bargain. And in my personal opinion, that's a smart move. As always, really appreciate you guys. Thank you so much for watching. Have a great day.